Richard Betts with ASCP Accounting and Payroll. Today is March 31st. We're going to cover the Paycheck Protection Program. The Paycheck Protection Program is one of two payroll assistance provisions under the CARES Act, which was signed last Friday, the other being the Employee Retention Tax Credit Program. The CARES Act essentially makes employers, or has employers, look at these two programs side by side and makes it to choose a path of which way they would like to go. Most people we're seeing are looking at the Paycheck Protection Program as the most beneficial. So today we're going to cover that extensively in this webinar. It doesn't preclude an employer from having employees use unemployment insurance to help them through this crisis. Nor employers' ability to use the Families First Coronavirus Response Act provisions that relate to emergency paid sick leave or expansion of federal FMLA rules to allow for paying of care of a dependent, like a child home from school or one of those programs. You could use an economic injury disaster loan. Most people will not. It could, in certain provisions, be rolled up. That'd be for your banker to discuss. So even though we're talking about this Paycheck Protection Program, don't forget about these other programs because they can be used in conjunction with it.
A lot of our clients are asking us, am I eligible? And we thought we'd describe who is eligible. It really is practically every business and nonprofit. It's any business with less than 500 employees, a 501c3s, any business or nonprofits meets the criteria. There are also some things for self-employed individuals that are also eligible for the Paycheck Protection Program. When can I apply? Well, as of now, the starting date is April 3rd. This Friday, small businesses and sole proprietorships can apply for and receive loans to recover their payroll and certain expenses through SBA lenders. Starting April 10th, a week later, independent contractors and self-employed individuals can apply as well. The other question is, where can I apply? Well, you can apply through any existing SBA lender or through any federally insured depository institution, federally insured credit union, and Farm Credit System institution. And for reference sake, there's 44,000 banks in the United States. Most of them are applying for this program, so they'll be able to make these loans. What do I need to apply? Well, you'll need to complete the Paycheck Protection Program loan application that was just released by the Small Business Administration today and submit the application with the required documentation to an approved lender that is available to process these loan applications. The deadline would be June 30th, but many people are starting and want to apply starting on this Friday, April 3rd. What other documents will you need? Well, you're going to need to provide your lender with the payroll documentation that the SBA is issuing to the lenders in terms of having their backup documentation. When making the loan application, the question arises about what do you need to certify? What's going to be on the application? Well, basically the application is starting with that you're certified that you need this loan necessary to support your ongoing operation because of the economic uncertainty that exists for all businesses today. And you also need to certify that it's going to be used to retain workers and maintain payroll. Keep in mind, the whole premise behind the Paycheck Protection Program is to get people off unemployment and get them on payroll. So the loan proceeds are earmarked to be used for putting people back on payroll. It also, you will be required to certify that you don't have another loan under this particular program. You're also going to need to certify the number of full-time equivalent employees on payroll. The loan forgiveness will be based upon on these criteria that you indeed use the loan proceeds to pay people and put people back on payroll that possibly have been laid off. You'll also acknowledge to the lender will calculate the eligible loan amount using the tax document that you submitted through Payroll for the previous time frame. So what lenders will not be looking for is the borrower does not need to have tried to obtain credit elsewhere. No personal guarantee on these loans. It's not required, and there's no collateral for these loans. Again, these loans are earmarked for you to use to get people on payroll.
The Treasury Department released this sample application form that you likely will see and certify with your banker. Your banker may ask for other forms as well at that time, but this is what we have at this moment to share.
How much can you borrow? That's the question a lot of people ask. Well, loans can be made up to 2.5 times the borrower's average monthly payroll cost, not to exceed $10 million. And how do I calculate my average monthly payroll cost? Well, it's the sum of included payroll costs minus excluded payroll costs, which we're going to talk about in a moment. Included for employers is the sum of payments of really any compensation you have. Salaries, wages, bonuses, commissions, payments of cash tips for those that are restaurateurs, payment for vacation, parental, family, medical leave, PTO. All of these types of wages are included. For sole proprietors, the sum of payments of any compensation or income to a sole proprietor that is a wage, commission, and this is basically the net income that's reported on Schedule C of their 1040 tax return. So the net income of a sole proprietor for the calendar year 2019 divided by 12 gives them their monthly income figure for the sole proprietors. What's excluded? Compensation of individual employees in excess of an annual salary of $1,000. $100,000, excuse me. Payroll taxes, and this means Social Security and Medicare taxes that the employer would normally pay. These taxes are not included in the calculation. Any compensation to an employee who is not a resident of the United States.
Looking at 2019 will be the primary starting point for most employers, taking the total wages for that year and then essentially dividing it by 12 to come up with the average. Some officers might want to look at each month's wages by month total, so we'll be looking to perhaps provide that detail if it's required. We're expecting that perhaps for seasonal employers or for businesses that were not in operation in 2019, but we're waiting further guidance for those types of businesses.
Here's an example of how we would calculate the basis of a Payroll Protection Program loan. This is for an employer that was in business for the entire calendar year of 2019. So the look-back period or the calculation period would be the period January through December of 2019. In this case, the applicable payroll is $1,600,000, which represents, as we pointed out, salaries, wages, vacation, all type of payroll that were paid to employees. In addition to that, state unemployment and local taxes are added to that amount. Now you'll notice we didn't include Social Security or Medicare taxes because they are not included, as we pointed out earlier. We're only talking about state unemployment insurance and local taxes if there are local taxes. On top of that would be any health insurance, employer-paid health insurance premiums paid. Not premiums paid by the employee, but that portion that's paid by the employer. So that cost could be added to the payroll, along with if the employer has a 401k or a simple match program, any contributions that the employer paid for as retirement benefits would be added to give a total eligible payroll cost for the year, in this case $1,760,000. That number is then divided by 12 to give you your average monthly payroll cost, and that figure is multiplied by 2.5 times to give you your loan amount that can be applied for under this program. The Paycheck Protection Program is specifically geared to get employees off of unemployment and get people on payroll. And in economic stress times like now, perhaps employers wouldn't want to put people on payroll. As an incentive, the program provides for a loan forgiveness. So they not only are going to loan you the money for the payroll for an 8-week period, but if indeed you keep people on the payroll for that period of time, at the end of that period you can apply for and receive forgiveness of the loan. It turns into a grant and there's no repayment of the loans. Now, this only applies if indeed you use the proceeds of the loan to cover payroll costs, but in addition to that, they're extending the fact that you can pay a mortgage interest if you happen to own your property, or if you rent your property, it will cover rent for the 8-week period along with utility costs, which includes things like gas, electric, telephone, and internet services. So that, along with making sure that your employee compensation levels are maintained, both in the number of people on payroll and the total amount that were paid in a comparable period, they will forgive the loan at the end of that period of time. So this is the most attractive part of this program.
I think it's important to stress that the loan forgiveness on the wages is for the 8-week period after the loan's origination. It's not for wages you're paying today and tomorrow, because it's not until the 8-week period. It's for the specific time period of those 8 weeks after the loan's origination.
Many employers are asking us, you mean they'll give me a loan for payroll and at the end of an 8-week period of time, they'll forgive the loan? How much of the loan will be forgiven? Well, 100% will be forgiven if you have the same number of employees and pay basically the same wages, the same level of wages you did before. Remember, the incentive is to get people on the payroll. However, you will owe money when your loan is due if you use the loan amount for anything other than payroll cost, mortgage interest or rent, and utility payments over the 8 weeks after getting the loan. Due to their likely high subscription rate, it is anticipated that they don't want that no more than 25% of the forgiven amount may be used for non-payroll costs. So they want 75% of the loan proceeds to be used for payroll. You will also owe money if you do not maintain your staff and payroll levels. So your number of staff, meaning your number of FTEs or full-time employees, will be reduced if you decrease the number of your full-time employee headcount. The level of payroll, if you were to reduce the total amount of wages by more than 25% for any particular employee designation, that would be reduced by a pro rata amount as well.
Many people are concerned about the fact that they've already let go of their staff. So there is provisions allowing time for you to rehire staff. Now, they don't have to be the same staff members. They just have to be comparably paid. And in fact, I believe there's room for changing even of job duties and descriptions and that kind of HR task that likely will need to change for a lot of businesses due to the economic situation.
And let's talk about an example of the actual loan forgiveness. So here's an example of use of funds for the loan forgiveness for the 8-week period. And again, as Mark pointed out, the 8-week period starts when the loan is originated, and loan origination means when the funds are dispersed to you. In this case, over that 8-week period, this particular employer had an applicable payroll of the $298,000, the state and local taxes on top of that, the health insurance that the employer paid, and this particular employer had a 401k or a simple plan. Here was the rent they paid. They didn't have any mortgage interest because they were renting their property, as most of our clients do these days. So that is the rent. And in this case, this is the amount of utilities. So that adds up to the total allowable expenses. But as you remember back from our example of the loan amount that was calculated was $366,000. As a result, this employer had an unforgiven amount of $18,000. And this $18,000 balance can be paid back because this is not going to be forgiven, but can be repaid over a period of 2 years at an interest rate of 0.5%.
It's something to look at, and we're still waiting a little bit more clarity on, is that 8-week period of time may not line up specifically to a month, and so we'll probably have to prorate your rent, prorate your utilities, things like that, but that'll be stuff we get from the bankers on the forgiveness side. Well, that concludes our wrap of the Paycheck Protection Program. Please stay tuned for more updates. We'll be posting to our help center and our newsletters, and your account managers always have some good details as well. Thanks, and stay safe.